Hello everybody and welcome to our Module 4 discussion on the topic of long-term assets and specifically depreciation. So as an overview, when we talk about long-term assets, we're talking about an asset that's expected to last longer than a year. In the last module we covered current assets, which are going to be used up in less than a year. This module we're talking about long-term assets or non-current assets that are expected to be used in the operation and last longer than 1 year. Again, the 1 year is a general rule, but we'll stick with that for our discussion. Now last module, we talked about notes receivables and accounts receivables. We said that accounts receivables are pretty much always going to be current. Notes receivables can be either current or long-term, depending on just how long the term is. We could have long-term investments, so you're whether it be a stock or a bond, you're holding it as an investment for the long term. And then the main topic of this particular module is long-term fixed assets, which there are a few different names for it. We'll see that in the next slide. So the ones we're specifically talking about are the fixed assets, which again, there are a variety of names we'll see in just a bit. But these are assets that are purchased not to hold as investments passively, but instead to use in our operations over multiple years. So there again are a variety of names for these. Fixed assets I've already mentioned. We have plant, property and equipment, or property, plant, and equipment, PP&E, plant assets, just general non-current assets, or long-term assets. So a variety of names that you might see. Now these include things like land, buildings, fixtures, equipment, again, things that we're using in our operations, vehicles. So we have a term here that we need to discuss called capitalization. And the point is, capitalization is the opposite of expensing something immediately. If that asset is going to be used for multiple years, we don't want to expense the entire thing in the first year. Now note that sometimes we might pay cash up front for an asset. Sometimes we might buy it by borrowing money. How we financed it really does not matter as far as how we need to treat it. The point is, if this asset is going to be used over multiple years, we need to expense it over multiple years, and that's where we get depreciation. But the first topic we need to talk about is capitalization itself, capitalizing the cost. What that basically means is we take that amount that we paid for the asset and we do not expense it right away. Instead, we treat it as an asset immediately, similar to what we did with supplies or even inventory. The big difference there is that with those, we were going to expense most of them that year. With a capitalized asset, a long-term asset, we're not going to expense it for multiple years. We're going to spread it out over multiple years. Now, the idea here is if we're using this equipment, for example, to help us run our company and generate product and generate revenue for 10 years, then it makes perfect sense we need to count that expense over 10 years as well. That's the matching principle. So now we have the question of what amount do we need to record initially as that capital asset. Now you might be tempted to just say, well, hey, what about the amount we paid for it? That makes perfect sense. But the correct answer is actually any amount that is necessary to purchase the asset and put it into service. So your largest cost out of that is generally the purchase price itself. You might have to pay freight. You might have to pay insurance during transit. Maybe you had to pay to get it installed. It could include some labor. It could include some supplies. Could include some renovations to the building, building a shelf for the equipment to sit on, things like that. And it could also include testing costs. So this might be you're using scrap materials. Let's say you have a drill or a saw you're installing. You might be using some scrap materials while you test it. These are all costs. We would capitalize it, and they'd get capitalized up to the point that we put the asset into service. Now let's talk about land. Land is a very unique asset as far as depreciation goes, and the big reason is it just does not get depreciated. No matter what we paid for it, no matter how long it's going to last, we never expense land. Now we might have a gain or loss on the sale of land at the end, but during its use, we do not do anything with it. It keeps its original value. So an example for the costs that we would capitalize for land would be the purchase price maybe any title fees we had to pay, unpaid property taxes if they were part of the purchase deal, and you might even have raising costs, which raising would notice with a Z. This means we're removing trees, clearing rocks, demolishing an existing building on the land that we're not going to be using. Those would all be part of the land's basis. And again, no matter what we put into this land's cost, it does not get depreciated over time. In fact, as far as a fair market value goes, it tends to appreciate in value. But again, fair market value is not what we're recording. We're recording the cost. That'll become important in the next few slides here. So the next topic we have is a basket purchase, also known as a lump sum purchase. And basically in this situation, we're buying multiple assets from a seller, but they didn't break out the cost of each asset or the price of each asset. They just said, hey, buy these 3 assets for this total amount and we're good. So there's one lump sum. Now remember, we need to record the cost of these assets. The problem is we don't know the cost of each individual asset. Somehow we're going to need to apportion that total cost between the various assets. And the reason this is so important is that the different assets are depreciated over different lives. Generally, they'll use the same method, but they'll be depreciated over different lives. They might even have different salvage values. So in the end, we need to make sure they're handled separately. Keep in mind also that land, which is quite often one of the pieces of a basket purchase, doesn't get depreciated at all. So we really need to keep that separate. Now the way we do this, since we don't know the actual cost, we can identify, hopefully, what the fair market value of each asset is, and then base our cost on its relative market value. In other words, the percentage of this one asset's fair market value compared to the total fair market value of all the assets that we purchased. So it's a percent to total proration. One example here, we have Joey's Lawn Service. They purchased land, a vehicle, a trailer, and a riding lawnmower. The total purchase price is $50,000, so we want to know how much gets recorded in the account for each asset. Now we know the total cost, so we know that whatever we record in the balance sheet has to equal up to $50,000. But we can't just plug it into one asset or the other. It's got to go into each of the assets as best of an estimate as we can get. So we need to know the fair market value of each asset. Now again, this assumes we can get an appraisal or have some way of getting a relative fair market value. So let's say we found out that the land was $40,000, the vehicle was $20,000, the trailer was $8,000, and the riding lawnmower was $12,000. So the total fair market value of all 4 of those assets would be $80,000. Now that does seem a little unusual that the fair market value is $80,000, but we were able to buy it for $50,000. Now, for these examples, they tend to be a little bit drastic just to make a point. There could be a situation where the seller really needed to sell them, sometimes called a fire sale, a distressed seller. So that might be the situation here. Now, we cannot just record the fair market value for each asset, as I said earlier, because in total we can only record $50,000, so we can't possibly record these fair market values. That would equal $80,000. Our journal entry wouldn't be right. We would be crediting cash for $50,000, and using this we would be trying to debit all of these assets for $80,000. We wouldn't be able to record that. So we have to record the fair market value, or the cost, as opposed to the fair market value, and this is because of the historical cost principle. The only thing we're using fair market value for is a basis for apportionment or allocation. So let's see how this works. We know the total fair market value of all 4 assets is $80,000. So for each asset individually, we take its own fair market value divided by the total. Land, for example, was 50% of the total fair market value. The vehicle made up 20 out of 80, 25%, and so on and so forth. Now that we have these percentages, 50, 25, 10, and 15, they add up to 100%, we can multiply that by the total cost. So the 50% multiplied by the $50,000 total cost is $25,000 in cost. That's going to be recorded for the land asset, not the $40,000 fair market value. Vehicle had 25% of $50,000, so it gets $12,500. Trailer had 10% of $50,000, so it gets $5,000. Riding lawnmower had 15% of $50,000, so it gets $7,500. And when you do the journal entry here, when you record all these assets, it's a total of $50,000 that would be debited, and a credit to cash for, or cash, notes payable, however we finance this, for $50,000. So remember, capitalization, that term, means that we're deferring the recognition of an expense until later periods when we've used the asset, and the goal, again, was to match the expense with the revenue that it helped to generate. We use the equipment, we use the building, we use the vehicle to help us generate revenue, so we want to try to match them as best we can. So you can capitalize an asset like land even if you're not going to do anything else with it. Capitalization itself just means you're recording an asset instead of an expense. Now, most of the capital assets, again excluding land, also get depreciated. Depreciation, I'm sure you've heard that term from a personal perspective with your vehicle or whatever, but depreciation is not the same that you might be thinking of from your personal perspective. You know, you might have heard the phrase that when you buy a brand new car, the second you drive it off the lot, it depreciates rapidly in value, that first minute basically, because now it's a used vehicle. So that type of depreciation reflects the decline in fair market value. Accounting depreciation is not trying to reflect the decline in fair market value. Instead, it's just a cost allocation mechanism to allow us to estimate as best we can the usage of that asset across the years. So here we have a very simple example, a $10,000 asset that's going to last 10 years, so it makes sense to depreciate approximately $1,000 per year. Now this is an extremely simple example. There are other things that often come into play here, something called salvage value, and then the method itself. But we're just going to use that example to see that the book value is declining. It's called the net book value, is declining over the years because we're shaving some off each year and sending it to expense. So let's say that was a 10-year asset. It was $1,000 per year. And let's assume we're in year 3 of 10, or actually we're at the end of year 3 of 10. We would have allocated $3,000, 3/10, $1,000 times 3 years as depreciation expense. Now you may recall when we talked about the journal entries way back in the adjusting entry module, I said we don't actually decrease the equipment directly. Instead, we use what's known as a contra asset account. It's called accumulated depreciation. So on the books, you still keep the original $10,000 in cost, but now we have $3,000 that's accumulated over the 3 years of depreciation. So we subtract that out, and our net book value is $7,000. So that's how much we have left in book value. Again, though, that may not be the fair market value at that time. That might be lower, might be higher. That's not our goal to try to approximate. We'll come back and talk about that later. So just a reminder that the accumulated depreciation is a contra asset account. It has a normal credit balance because it's the opposite of the asset. Assets have a normal debit balance. A contra asset has a normal credit balance. To increase it, you credit it throughout the life of that asset. Now this offsets the asset's net book value. That's the whole goal. It'll grow over time. Therefore, the net book value will drop over time. So let's look at what's called a depreciation schedule. Now you'll see different styles of this. Some of them have more columns, some of them have fewer columns. This is just a pretty basic one. We're looking at our 10-year life. Sometimes they even start with year 0 just to show you what the original cost was. But year 1, we had a beginning net book value of $10,000. Now, I want to stress something here. This is always going to be the cost. Later on, we'll talk about salvage value. That has no impact whatsoever on beginning net book value. So we have 10,000, and then you either have one or two columns representing the journal entry. The thing is, it's going to be the same amount. Whatever you debit to depreciation expense, you also have to credit for accumulated depreciation. So you can either split it to two columns, or you can just make it one column, because these two always have to be the same amount. Now we have total accumulated depreciation, basically the running total of that, which increases over time by this amount of the journal entry. And the net book value, this is ending net book value for the year. That's essentially the beginning amount minus the amount we've recorded as journal entry that year. That gives us our ending net book value, which of course carries over to become next year's beginning net book value. As the accumulated depreciation increases, the ending net book value decreases. Now in this very simple example, we're going all the way down to zero. There's no salvage value. So that means the accumulated depreciation will increase all the way to the total cost, and therefore the ending net book value will decrease all the way down to zero. Now here's something you may have noticed by now. No matter what year we're in, if you add up the total accumulated depreciation and the ending net book value, you're always going to equal the $10,000 cost. 1 and 9, 4 and 6, 7 and 3, 10 and 0. So that's always going to equal the net book value. The point is, the cost is either in the net book value or it's been depreciated out. That's the point. Now here in year 3, just as we saw a bit ago, we've had $3,000 of accumulated depreciation out of $10,000 total. Therefore, our net book value is $7,000. Now again, we talked about this in the adjusting entry module. I said, of course, we're going to debit depreciation expense, but we are not going to credit the equipment asset directly. Instead, we credit that accumulated depreciation entry, and that's the contra asset. It offsets the asset value. Anytime you hear the contra term, it's offsetting whatever it's contra to. Contra assets are very common. Later on, we'll see contra liabilities. We'll see contra revenues. We will see even contra equity accounts. They're always the opposite. Just to throw an extra piece in there, we'll also see what's known as an adjunct account, specifically with the liabilities. That's the opposite of a contra. That adds to the value of that particular account. That's not nearly as common as a contra account. We'll see that with bonds payable in the next module. So the point is, over time, our accumulated depreciation is going to increase and the net book value of that asset decreases, but on the balance sheet, that historical cost of that asset generally stays the same. Now I say generally, we'll see an example at the very end of part 2 of this module where that could even change. If you add a new wing onto your hospital, if you overhaul your engine and transmission in a vehicle, you might be adding new cost into that asset. That'll come later on. But generally speaking, the cost, the asset's original value, stays the same. So as far as depreciation, we gave the example of $1,000 per year a bit ago, but in reality we need to calculate that, and that'll depend on what method we're using, which we'll talk about in a bit. It'll depend on the estimated life of the asset, how many years, how many months. There are some other ways to measure life we'll talk about. And it'll depend on the estimated scrap value, also known as residual value or salvage value. This is basically the amount of that cost that we do not want to depreciate because we don't think we're going to use it up. We think when we get ready to sell this that cost will still be there. We're not going to use it in our operations. And it's an estimate. In fact, certainly these last two are estimates, but even the third or the first one is an estimate about how quickly it'll depreciate. The method estimates how quickly it'll depreciate over its life. So overall, depreciation is an estimate, and it can be changed if you have a new life estimate, better data out there. If you have a new scrap value estimate, that depreciation can change over time. That's the point. The method can change over time. The estimates themselves can change over time, and it's prospective. It's not a mistake. We adjust it going forward. So let's look at some of the methods. We have straight line, which is by far the most common, and it's the easiest method. It's actually what we've been using up to this point. Basically, you take the amount that you want to depreciate, which it could be the cost like we did before, or jumping down here, it might be the cost minus some salvage value that we want to keep within the asset. That gives you what's known as a depreciable cost, the amount of cost you want to depreciate over its life, and then you spread it evenly over the number of years or months or whatever you're trying to depreciate it over. Depreciable cost divided by the life of the asset in years gives you the straight line depreciation amount per year, and it'll be the same every year. That's the other key thing about it. So here we have a little bit different, $100,000 cost. Now it has a $10,000 salvage value and a 10-year life. So notice again, regardless of what salvage value we have, our beginning net book value is still the full $100,000 cost. Salvage value does not impact net book value at all. What it impacts is the depreciation calculation, because we take cost minus salvage value to get the amount we want to depreciate. And then we divide that by the number of years. So 90,000 divided by 10 years gives us 9,000 each and every year, exact same amount each and every year. So notice that every year the total accumulated depreciation will increase and the ending net book value will decrease until at the end we stop at $10,000. That's a key thing to note here, because we only wanted to accumulate $90,000 of depreciation because that's the depreciable cost. Assuming none of our estimates changed, we want to stop at $90,000 and we're good to go. So that is a rule I want to point out. With straight line, it takes you right there automatically. There's no question. But some of the other methods later on, it might not automatically stop there. So we have to be careful. We have to always end it right at that net book value. Let's take a look at another method. Units of production depreciation. This is still, it's referred to as kind of a straight line because it's the same amount per unit. The only difference is the unit is no longer the year. Straight line, the unit is either a month or a year. Now it's some sort of unit. It might be a machine hour. It might be an actual unit of product. It might be a mile if it's a vehicle. We're measuring some sort of unit as opposed to a calendar year or a month, anything like that. The first part of the calculation is still the same. Cost of the asset minus the salvage value. That gives us the depreciable cost that we want to depreciate. The difference is what we're dividing that depreciable cost by. It's still going to be the life of the asset, but it's no longer in years. It's in units. So now we have to estimate how many units do we think we're going to produce throughout that asset's life. How many machine hours? How many actual units do we think the machine will produce? How many miles will the vehicle go? And what that gives us is an estimated depreciation rate per unit. And then every year or month or quarter when we're trying to record a depreciation entry, we count how many of those units we actually used and multiply it by the same rate every time. That gives us the depreciation amount per year. Now the thing I want to point out here is this is an estimate. So if you estimate that your vehicle will go, your delivery vehicle will go 200,000 miles, let's say, how likely is it that that vehicle is exactly going to stop at 200,000 miles? We can't go a mile above it, and it won't break down before that, or we won't get rid of it before that. It's not that likely to be perfect, And it could go either way. We could go too many. We could not quite go all the way. So that's the point I'm trying to make here. You might need to make an adjustment at the end to make sure that you don't depreciate below that salvage value. So let's say we estimate 200,000 miles. Let's say the vehicle actually went 220,000 miles before it completely stopped working. That extra 20,000 miles would have given us more depreciation than we wanted. So what we need to do is at that last year, we just stop it as soon as we've gone down to the $10,000 salvage value. Again, that assumes that we haven't changed the salvage value estimate or things like that. You might end up changing the life. Now, if you change, let's say we're in year 8 of 10, and now we realize, this vehicle is not going to last as long as we thought. It's only going to give us 170,000 miles. You can change it at that point and recalculate your rate going forward. But if it's in the very last year, then generally speaking, it's just adjusted that year to get you right where you want to be. So let's take a look at what that depreciation schedule would look like for the units of production depreciation. So let's say in this example we have $100,000 cost, $10,000 salvage value, and here we expect this equipment to give us a million units throughout its life. And keep in mind, this might be multiple pieces of equipment that we're lumping together, whatever the case may be. But the calculation we want is $100,000 cost minus the $10,000 salvage value. That gives us the depreciable cost, and then we're going to divide it by those 1 million units to get 9 cents per unit. Every time a particular year has a unit, it's going to give us 9 cents of depreciation. So here we have to add another column, and actually 2 extra columns for the depreciation schedule related to the units of production method. And that's because we need to know the units produced in a particular year. Now notice here, some of these even had 0 in that year. Now, of course, that seems odd that an entire year would have 0 units produced. Maybe it's out of order. Maybe they switched over to production of something else. Or keep in mind, we're just out of the COVID years, 2020, 21. Maybe year 3 was 2020 or 2021 where the equipment was not being used, the factory was shut down. Things like that certainly can happen. In that situation, it means they're not going to have any depreciation expense that year either. So remember, we're estimating 1 million units, and we're doing this across a 10-year period. Chances are we're not going to be right on the dot, and that makes sense. But in this example, it's a pretty straightforward one. So what we're doing each year, we take the units produced that year, multiply it by 9 cents, and we get the depreciation expense for that particular year. We keep adding it to our total accumulated depreciation here. It keeps increasing over time. And if everything works out perfectly, we'll end up with exactly $90,000 of depreciation, which is where we want to be. And then our ending net book value is going to be down to $10,000. So again, if there's 0 units produced in a year, it gets 0 depreciation. Now this worked out nicely because it exactly equaled up to 1 million units. But let's say year 10 ended up having 60,000 units produced. We still want to keep the 10,000 salvage value. So if we had 60,000 units produced, which takes us over the 1 million units, and that would take our total depreciation above 90,000 and our net book value below 10,000, we would basically say we don't want to do that. In this case, we look at the year right before it, or we look at the beginning net book value for the last year, and we say we're at 14,500 and we want to get to 10,000. So we basically say we know we need to depreciate 4,500. So in this year it worked out nicely, but even if it didn't, even if there were more or fewer than 50,000 units produced, we know we're going to depreciate $4,500 to bring us exactly where we want to be. So that's the point with depreciation schedule for units of production depreciation. So that takes us through part 1. We've covered straight line and units of production. We'll come back in part 2 in just a little bit. It's a great pausing point, and we'll talk about the double declining balance methods and then some additional topics related to capital gains and losses, routine maintenance, extraordinary repairs, things like that. So I'll see you here in part 2 shortly.